Welcome, everybody. In this December episode, we are going to dive deep into the powerful calculation tool that can be predominantly used throughout your investment journey. That is how to use the cash flow calculator tool from ChatGPT, simplifying the whole calculation process and empowering you to deriving the investment strategy for the best outcome. This episode is brought to you by Future Secure Advisory, and I am Varun. Now, before we get deeper into this tool, let me ask you a question. Have you ever done something you are good at but didn't really know why you were doing it? Sometimes we get focused on the what that we forget the why. And trust me, understanding why is crucial because without that clarity, you don't have a clear GPS to guide you to your destination, right? The same principle applies when you are procuring property for an investment journey. When you purchase a property, it's vital to know where you are starting in terms of cash flow. Understanding your cash flow from day one before the mortgage repayments kicks in and before the ongoing expenses start flowing in is the foundation of a successful investment. You need to know exactly where your investment is headed and how smooth or bumpy that ride will be. This is where our cash flow calculator tool comes in. It's not just about knowing where your journey starts, it's also about understanding where you are heading to. How will your investment evolve? The evaluation is more important, and you need to understand how that is reaping the benefits to you. When will you transition from negative gearing to neutral, or for that matter, even the passive income generation? These are the crucial questions, and with the tool that I'm going to present to you, will help you to get the answer for them. But before we get into the walkthrough of this tool itself, let's take a step back, understand why this is so important. Let's dive in and build a strong foundation for your property investment strategy. And that's where I strongly believe that I'm bringing the value to you through this delivery of content itself. Are you ready? Let's get started. So, the missing piece, the cost of holding your property. As an investor, you need to calculate more than just the initial price of your property, which, in other words, about more of your purchase price itself. What about the ongoing expenses? What are the hidden costs, such as building insurance, content insurance, property management fee, initial letting fee, vacancy fee, water and sewage services, and bank charges, and, and others. These are the costs that can quickly accumulate, affecting your cash flow and, most importantly, your lifestyle as well. Imagine this: you have secured your dream investment property, but now you hit with the unexpected expenses that start to feel like a burden. The financial pressure builds, and suddenly that property you bought with dreams of getting a passive income turns into an ongoing drain on your resources every day, each day from the day you purchased this property. This is where most investors get it wrong. Too many investors fail to account for these ongoing costs upfront. They look at the property purchase as the only step, but not considering the expenses that come with maintaining it is like setting yourself for failure. The surprise hits when they realize that the expenses for holding the property are higher than expected, leading them into a heavily negative gearing situation. But it doesn't have to be this way, right? That's where I want to shift your mindset. And that exactly is this cash flow calculation tool is being positioned for you by me. Starting with this tool, is the first step to ensuring you know exactly what it will cost to hold your investment before even you make the purchase. That's more important. Before even making your purchase, you need to know what would be your holding cost, or what is a fee that you are ready to pay in order to hold this property for the financial freedom that you are after. This tool will allow you to map out your expenses and see the financial picture clearly from day one. So that gives a coverage on why we need to do this, rather than focusing on what are the elements in it, because the elements of what part will be covered very intuitively by the tool itself, what we generated for you. So let's dive into the tool. And the tool is driven by prompt prompt nature, where you feed in the answers for the questions that the tool asks to you, and based on the input it provides you the calculation and the outcome from the calculation itself. So let's see how to access the tool. So I have given in the description box below in this YouTube video, where you can find the link for this tool itself. So let's go in. So once you are in this tool, it will give you the screen such as like this, where you click to start chat and you will be prompted with few inputs that will allow the tool to calculate your cash flow based on the property you are looking for purchase. It is user friendly, as I said. For this tutorial, we will use the fictional characters Manny and Rani, a hardworking couple who moved to Australia 5 years ago. They have recently secured their primary place of residence and are now ready to start their investment journey. So here is how it works with the tool. Let's assume the property that they are looking for is around 500k mark, and it's a 3 bedroom, 1 bathroom, 1 car garage kind of configuration, sitting at around 950 square meter block of land. So here Manny and Rani are looking at the foundation of how to establish their investment journey, and that's where they are into the calculation before making the offer placement itself, in the form of a written offer in the email, or it could be in a kind of a contract of sale as a kind of a signed document itself. But before even going through those steps, they want to know, and they would like to know, what is in it from this property if they procure it, if they purchase it, what it means to their lifestyle by holding this property for the financial freedom that they are after, in the form of passive income or in the form of equity generation, whatnot. And to do that, that's where they are using this tool. Now let's engage this tool by giving the prompt, and from there the tool will ask only essential questions about your purchase price. What's the deposit amount? Of course, you will be going to the lender, and what is the percentage in there that lender is going to contribute to purchase this property? What's the interest rate charged by the lender? And what's the projected rental income? Of course, you would do, as Manny and Rani has done the due diligence. I'm not going to go through the part on how they have done the due diligence of deriving the rental appraisal for the particular property that they're looking to purchase. But these are the inputs that the tool requires in order to do the calculation. So here, Rani and Mani are trying to punch in some of the numbers, which is for the purchase price. They're doing it as $511,250. Then the tool asks for what is the deposit amount you're going for. The deposit amount they have sourced it as 20%, so they provide that. So of course the remaining amount is what is the bank will lend, so it's going to be 80% anyway. And then the next question is all about what is the interest rate that's been offered by the bank for lending this money. So it's going to be 6.29%, which they have, which Rani and Manny has got that information from their mortgage broker. And now the final question from the tool is all about, hey, can you give me the rental income that you expect per week? So they have sourced this information as $570 per week. That's all the tool needs from the user, from the buyers. And then it does all the calculations based on some of the assumed values in terms of council rates, building and content, insurance, property management fees, initial leasing fee, admin fee, and vacancy fee itself. So those are the fees, that are the expenses in conjunction with also the mortgage payment. Repayment is also an expense, right? So that's exactly is where the calculation is performed, and from there it calculates the total income versus the total expense, and that's what is the summary table that you see here. The rental income is derived from the input on the weekly rent that Rani and Mani has provided. The fixed expense is calculated based on all the normal expenses, assuming the property management fee is 8% from the income that we get from the rent itself, mortgage repayments based on the interest rate and based on the borrowing that we are making, and thereby it gets you the net cash flow. So this tool is also very intuitive to uh, to to override some of the expenses that it has assumed in its calculation. Say for example, let's say let's change the insurance cost from the assumed value of $2,800 per year to $1,800 per year. We can do that. So we just provide this input, and then the tool is intelligent enough to recalculate the expenses based on the newly overridden element and its value on that element itself. So there you go. We just, it was able to override the value. It was initially $2,800, which was assumed. Now that's the reason why it provides you with the indicator saying that it's been updated because it's been overridden now. Now you could see that the net cash flow has been changed and it's been considerably reduced when compared to the previous outcome. Now that's kind of a net cash flow before tax, and the tool is intelligent enough to calculate the post-tax um, calculation as well, based on the tax bracket by which Manny and Rani falls under as a family, because they are purchasing this property under both their names. So let's calculate the post cash flow. So from here, it again asks for a specific question, very specific to Rani and Mani's situation. What tax bracket are they under? So they are under 45%, which I know that. So from here, it makes the calculation. So to give you the indication of if you purchase this property, what would be the post-tax calculation, and what would be the cash flow. Is it negative? Is it positive? Or is it neutral? So for the property, what Rani and Manny are looking at, if at all they are successful in from the point of say their offer has been accepted by the seller, and they don't have any surprises in the form of due diligence, such as the inspections that they conduct in the form of building, pest, plumbing, electrical, etc. And of course, they would have done that due diligence of the fire and flood risk before even placing the offer. So after all these things, these elements in the settlement process, and they have come to that settlement, and with a firm confirmation that they were able to secure a tenancy with a rental income of $570 per week, what they are going to see is they are going to see a, in a post-tax cash flow calculation yearly, they will they will lose around $950, and before tax it's around 518 80 5,000, sorry, $5,800. So that's a kind of a calculation that you can get from this tool itself. So this gives you a kind of a concrete understanding where exactly you are sitting in terms of purchasing the property, so that there are no surprises when it comes into BAU, that is at the time of tenancy itself. So so this is a typical scenario. Let's assume that Rani and Manny are looking for a property where they want to explore how would be the cash flow outlook would look like if the property is of a purchase price at $740,000 with a rental income of 550 per week. Let's do it again, right? So we can prompt the tool to start it again. So it's going to start with the asking the purchase price. So as I said, in this scenario, the purchase price is around $740,000. And let's assume again they are going for a 20% deposit on the purchase price, which I believe they have the fund to feed that much amount of money for this purchase price, and remaining purchase amount is what they will be seeking it from lender. And then the interest rate, let's put it as same, which is 6.29%. And let's give the rent as $550. So this is just to get them the awareness of what exactly is the property that they're looking at. Just by looking at the numbers itself, the purchase price is so high, the rental income is less relatively to the previous scenario. Anyone with an objective mind, they should be able to, it's an obvious thing, right, that this is not going to fetch you a good cash flow outlook. But anyway, let's put it in this tool and let's see what the tool is going to give with exact calculations, with all the kind of default values in terms of the expenses that we have factored in. It would calculate the cash flow and cash flow before tax, right? So as you could see, that next net cash flow is sitting around 20,000, give or take $20,000 per year. We are assuming that Rani and Manny are going into this property with this kind of a purchase price. Most likely it's because of newly built house. It could be from a house and land package. etc., etc. So we're not going deep dive onto that, what are the circumstances by which this property's price is being determined. But we know that the property price is way higher than what they have initially factored in the previous scenario, and also the rental income in this scenario is way lesser than what we factored in the previous scenario. So yeah, so now it gives you a kind of a feel where how exactly you can determine the kind of a decision in your investment journey, whether or not, during the offer placement process itself, you can you can make the decision just by leveraging this tool, and as if you are speaking to a kind of a human being, or per se any kind of home assistants like Alexa, right, or Google Home itself. It's that helpful. For that matter, you can also use this tool to go back to your previously provided prompt, and and then you can start projecting yourself what would be the outlook on the second year, third year, fourth year, etc. So for that matter, let's start again for the scenario one. So the purchase price, again, they are looking at, Rani and Mani are looking at around 511,000 for the 3 bedroom, 1 bathroom, 1 car garage configuration, and the deposit is still sitting at 20%. The scenario here, what we are trying to achieve is, like, we tried it with the rental income of say 570 in the first iteration, right? So in this iteration, what we are going to do is, we are assuming that this calculation is being done just to see how Rani and Mani are positioning themselves for the second year, for that matter, with an assumption of there was a 10% increase in the rental, because the market is hot and the rental demand is very high, and that's why the rental appreciation has gone, which is favoring as an investor for Rani Mani's situation itself. And also, hypothetically, we are assuming that the interest rates have gone down a bit in there, which is where around, let's say they are sitting at 5.95% from 6.29% from the previous year. It's a big jump, but we are making a guess here. And the rent is being moved from 570 from dollars per week from the first year to, let's say, $630 per week in the second year. Now, if you do this calculation, now Rani and Mani can understand where they're landing on the second year, with the variables and shifting the values on those variables, so to speak. And from there, they can understand how are they going to slide into, say, they started with negative gearing, and how long does it take them to move into neutral to positive gearing. So as you see in the previous iteration with $570 a week a rent, and also with their bank interest rate of 6.29, they were sitting around at a negative cash flow of around $5,000 to $6,000. Now, with just two variables being adjusted, which is interest rates going down to 5.95%, and then the rental income has been pushed to $630. Now their net cash flow is around $2,708. And you can imagine, it's very obvious, if you go in a third year, it's at least a 5 or 6%. This property will immediately go into the neutral gearing, or into getting into the positive gearing slider itself. So that's so much powerful this tool is, and that is exactly why I emphasize and I produce this tool to you to enable you to visualize how your investment journey would look like before even placing the offer. So, so as you can see, this tool is incredibly powerful in projecting the financial journey of your property investment. By simply adjusting the rental income and interest rate, you can see the potential evolution of your cash flow over time, allowing you to make informed decisions every step of your way. For Manny and Rani, this means that they can go heavily negative cash flow to neutral gearing, which will enable them to start building the equity and grow their portfolio without the burden of overwhelming their expenses at the cost of diminishing their lifestyle for themselves and for their family members as well. So, how this tool can transform your investment journey? By using this tool, Manny and Rani are just not making the guesses about their investment future. They are planning strategically and optimizing their property's cash flow. This tool provides you with the clarity and insight you need to make decisions based on real data, ensuring that your investments are sustainable and profitable in the long term. So, whether you are just starting out or looking to refine your property investment strategy, this tool is a game changer. As I mentioned, the link to this tool is provided in the description box below. And this episode is brought to you by Future Secure Advisory. Thank you.